Hello and welcome to this session. In this session, you will learn about traders, investors and hedges, foreign institutional investors or FIIs, and domestic institutional investors or DIIs. Let's begin with traders, investors and hedgers. Do you know that these are three different players and these terms are not to be used interchangeably? Let's learn more about each market maker. Let us begin with traders. A stock trader is a person or company involved in trading equity securities. Stock traders may be an agent, hedger, arbitrager, speculator, or investor. Stock traders advise shareholders and help manage portfolios. So what do traders actually do? These are the individuals or institutes who trade daily and keep the momentum in the market. They are active players who buy and sell the securities to such an extent that if there are any discrepancy in price equilibrium, the same gets corrected. Their portfolio is not constant and changes over a period of time, and they react to market news faster. Traders are responsible for daily changes in exchange indices. Speculation means traders buying or selling securities on the stock exchange with a view to make profits to anticipated rise or fall in the price of securities. Speculation leads to risky investment since securities don't always move upward or downward as expected. Stock speculators usually try to profit from short-term price volatility with trades lasting anywhere from several seconds to several weeks. Traders are known for their speculative activity. Speculators make bets or guesses on where they believe the market is headed. They do not take delivery of securities, but only pay for the difference between the purchase and sell price. Now coming to investors. Investors are those individuals who buy stocks and hold them for a long time to gain income in the form of dividend along with capital appreciation. The key point to remember is that investors, unlike speculators, are in it for a long haul. Let us now study who is an investor. Investors are those individuals who buy stocks and hold them for a long time to gain income in the form of dividend along with capital appreciation. They usually are passive traders in market. They are also responsible for steady markets. These are individuals who do not react to market sentiments quickly in either bullish or bearish markets. Investors are never a part of extreme market movements and are responsible for long-term growth of stocks to which they are loyal to. An investor also conducts extensive research and observation of how financial markets perform. Moving on to hedges. An investor who takes steps to reduce the risk of an investment by making an offsetting investment. Let us focus on the role of hedges. Hedges in the futures market try to offset potential price changes in the spot market by buying or selling a futures contract. Hedging involves taking an offsetting position by taking an opposite position in the market to what they are trying to hedge. They are seen as risk averse since they try to reduce the risk associated with uncertainty. Coming to the main differences between traders, investors, and hedgers. Traders. Traders are also called speculators. Their investment is always short term, ranging between 1 or 2 days to weeks. They are risk takers believing in news and rumors and are generally optimistic. Speculators are those buyers who are involved in intraday trading. The idea of gain is to earn profits from the daily fluctuations in the market. Now, investors. Investors invest their funds with a long-term view, ranging from months to years. They do not believe in intraday trading. Their investments are based on extensive research and don't react to market momentum easily. Their strategy is to buy and hold, the long-term strategy, which is passive in nature. Hedgers. Hedgers can be either investors or traders, but they always offset their position, thereby minimizing risk. Hedgers are more active in derivative products. They always invest in equal and opposite positions. In the real world, their portfolio is short-term based. Next, we study about the foreign institutional investors. An FII is an investor or investment fund that is from or registered in a country outside of the one in which it is currently investing. These are the big companies such as investment banks, mutual funds, etc., who invest considerable amount of money in other markets. With the buying of securities by these big players, markets tend to move upward and vice versa. They exert strong influence on the total inflows coming into the economy. The FIIs are considered as both an extractor and a channel for the market performance by encouraging investment from all classes of investors, which further leads to growth in financial market trends under a self-organized system. Their role in the economy is to act as highly specialized investors on behalf of others. Entry and exit is relatively very easy for an FII as compared to FDI. There are various types of FII such as endowment fund, hedge fund, insurance company, asset manager, investment company, investment trust, mutual fund, pension fund, sovereign wealth fund, and unit trust and unit investment trust. Indian market was opened in 1992 for foreign institution investors. In order to trade in Indian equity market, foreign corporations need to be registered with SEBI and shall comply with the exchange control regulations of RBI. Around 1,550 registered FIIs are operational in Indian market. FIIs offer a range of services and can deal in primary and secondary markets, including shares, debentures, and warrants of either listed, unlisted, or to be listed companies. It also includes units of mutual funds, government securities, derivatives, and commercial papers. Foreign investment in India is regulated by Government of India's FDI policy. The FDI guidelines administered by the Ministry of Commerce and Industry. Ceiling for overall investments of FIIs was increased to 24%, and investment in government securities was increased to $5 billion. Let's take a look at the effect that FIIs have on market makers. Stock markets. The increase in investment by FIIs increases stock indices, the stock prices, and encourages further investment. Enhanced interest shown by FIIs help increase the flow of equity capital. FII inflows help in financial innovation and development of hedging instruments. Macroeconomics. The excess supply of foreign currency causes a higher demand in the rupee, which in turn appreciates its value. FII inflows cause the RBI to pump in extra liquidity, which often leads to extra money supply, leading to an increase in inflation. Foreign money in the form of US dollars, euro, pound, and other currencies help increase the forex reserves of the country. Next, we come to DIIs. A DII is an institutional investor that has met certain qualifications to invest in securities outside its home country as well as foreign countries. Institutional investment is defined to be the investment done by institutions or organizations such as banks, insurance companies, mutual fund houses, etc. in the financial or real assets of a country. These investment decisions are influenced by various domestic economic as well as political trends. In addition to the foreign institutional investors, the domestic institutional investors also affect the net investment flows into the economy. A domestic institutional investor is an investment system which has the purpose of further relaxing the control on capital accounts in order to create more demand for foreign exchange so that the appreciation of the local currency would slow down and more domestic enterprises would be encouraged to go out and thereby reduce this trade surplus. The domestic institutional investors' activity is also based on BSE and NSE on capital market segment, and it is assembled from trades that are executed by insurances, DFIs, MFs, banks, and new pension system. There are many DIIs in India, such as Industrial Finance Corporation of India, IFCI, Industrial Credit and Investment Corporation of India, ICICI, Industrial Development Bank of India, IDBI, the state financial corporations, Life Insurance Corporation of India. The total number of domestic institutional investors, especially the mutual funds, is 40 in number. Given on the screen are the top domestic investors along with the value of the investments in India. LIC's emergence as the biggest investor in the country should not surprise anyone. The state-owned company is 51-year-old and enjoyed a state-sanctioned monopoly over the life insurance business till 2000. The firm has issued 220 million policies and earned total premium income of 39,541 crore in 2006-2007. It is allowed to invest 35% of its funds in equities. The largest chunk in LIC's portfolio is the stake it owns in listed engineering giant Larsen & Toubro Limited. The 15.7% stake in L&T is valued at more than 19,642 crore rupees. Other major investments include a 4.14% stake in Reliance Industries Limited, the largest Indian company by market capitalization, 7.2% in ICICI Bank Limited, 13.4% in ITC Limited, and 4.2% in Reliance Communications Limited. During 2008 recession, FII withdrawal effect was offset by the huge investment made by domestic institutional investor, especially LIC, which saved the market from a heavy meltdown. With this, we end today's session. We hope you enjoyed it. Thank you.